Hello and welcome. Have you ever wondered what goes on behind the scenes of a successful business? We see the products, the marketing, and the leaders, but who is navigating the financial waters? Who is steering the ship, ensuring it avoids hazards and reaches its destination profitable and secure? In many organizations across the United States, that person is the finance officer. This series will pull back the curtain on one of the most critical roles in any organization, exploring what a U.S. finance officer actually does. Before we dive in, it is essential to state that the information provided in this series is for educational and informational purposes only. It is not intended to be, and should not be taken as, financial, investment, tax, or legal advice. The role of a finance officer is highly complex and specific to the organization they work for. For any personal financial decisions, you should always consult with a licensed and qualified professional who can understand your individual situation. So what is a finance officer? The title might sound straightforward, but it represents a role that is far more than just counting money or managing spreadsheets. Think of a finance officer less like a bookkeeper, who records the financial history of a company, and more like a strategic architect, who designs the company's financial future. Their primary responsibility is to ensure the overall financial health and long-term sustainability of their organization. They work in every sector you can imagine, from multinational corporations and tech startups to government agencies and nonprofit charities. While the specific goals may differ, the core function remains the same: to provide the financial leadership necessary to achieve the organization's objectives. To truly understand what a finance officer does, we need to break down their key responsibilities. One of their most important functions is something called financial planning and analysis, often referred to by its acronym, FP&A. This is the forward-looking part of the job. It's about creating a map for the future and analyzing the journey along the way. FP&A can be broken down into three main activities. The first is budgeting. A budget is a detailed financial plan for a specific period, usually a year. The finance officer leads the process of creating this budget. This isn't just about limiting spending. It's a strategic document that allocates resources, money, staff, and assets to different parts of the organization to help it achieve its goals. For example, if a company wants to launch a new product, the budget will allocate funds for research, development, production, and marketing. The finance officer works with leaders from every department to ensure the budget is both realistic and aligned with the company's overall strategy. The second activity is forecasting. If the budget is the roadmap for the year, the forecast is the regular weather report. Forecasting involves using current data and historical trends to predict future financial performance. Unlike a budget, which is typically set once a year, forecasts are updated regularly, perhaps quarterly or even monthly. This allows the organization to react to changing conditions. For instance, if sales in the first quarter are much higher than expected, the finance officer will update the forecast to reflect this. This might lead to strategic decisions, like increasing production or hiring more staff to meet the new demand. Forecasting gives the organization the agility to adapt. The third, and perhaps most critical, activity is analysis. This is where the finance officer answers the all-important question: why? They perform what is known as variance analysis, which means comparing the actual financial results to what was planned in the budget. If the company spent more on marketing than budgeted, the finance officer digs in to find out why. Was it a planned decision to boost a campaign, or was an expense simply higher than anticipated? This analysis provides crucial insights that help leadership make better informed decisions. It's not about placing blame, it's about learning and improving. This is how a finance officer transforms raw data into actionable business intelligence. In summary, this first pillar of a finance officer's role, financial planning and analysis, is all about strategy. It's about setting the course through budgeting, anticipating challenges through forecasting, and understanding performance through analysis. They are the strategic partners to the CEO and other leaders, providing the financial context needed to guide the organization forward. In our next chapter, we will explore the other side of the coin. We'll move from looking at the future to ensuring the accuracy and integrity of the present and past through financial reporting and internal controls. Welcome back. In our first chapter, we explored the forward-looking, strategic role of a finance officer, focusing on how they use budgeting, forecasting, and analysis to help plan an organization's future. Today, we turn our attention from the future to the past and the present. We'll examine how a finance officer acts as the guardian of accuracy, ensuring that the story a company tells about its financial performance is both true and reliable. As a reminder, This content is created for educational purposes only and does not constitute financial, legal, or tax advice. We are discussing the professional functions of a finance officer within an organization. For personal advice, please consult with a qualified professional. A finance officer's second major responsibility is financial reporting. If financial planning is the roadmap for the journey ahead, then financial reporting is the official ship's log, detailing exactly where the ship has been and its current condition. This involves preparing standardized reports, known as financial statements, that communicate the company's financial performance and position to various stakeholders. These stakeholders include internal parties, like the CEO and the board of directors, who need accurate information to make sound decisions. But crucially, it also includes external parties. These can be investors who need to assess the company's health, banks that are considering lending money, or government agencies like the Securities and Exchange Commission, or SEC, which requires public companies to disclose their financials to ensure market fairness. To tell the complete financial story, a finance officer typically oversees the creation of 3 key reports. First is the income statement. You can think of this as the company's profit scoreboard over a specific period, like a quarter or a full year. It starts with the company's total revenues, or sales. From that, it subtracts all the costs and expenses incurred to generate that revenue, such as the cost of goods sold, employee salaries, and marketing expenses. The final number at the bottom is the net income, or profit. This statement answers the fundamental question: did the company make money during this period? Second is the balance sheet. Unlike the income statement, which covers a period of time, the balance sheet is a snapshot in time. It shows the company's financial position on a single day. It does this by listing 3 things: assets, liabilities, and equity. Assets are what the company owns, like cash, inventory, and property. Liabilities are what the company owes, like loans to a bank or payments due to suppliers. Equity is what's left over for the owners. The balance sheet presents a fundamental equation. Assets must always equal liabilities plus equity. It gives a clear picture of the company's overall worth and financial structure at that moment. The third key report is the cash flow statement. This report answers one of the most critical questions in business. Where did the cash come from, and where did it go? A company can be profitable on its income statement, but still run into trouble if it doesn't have enough cash to pay its bills. This statement tracks the actual cash moving in and out of the company from its operations, its investments, and its financing activities. It provides a real-world look at the company's ability to generate cash. Now, creating these reports is one thing. Ensuring they are accurate and trustworthy is another challenge entirely. This leads us to the next core responsibility: establishing and maintaining internal controls. Think of internal controls as all the rules, policies, and procedures that safeguard an organization's assets and ensure the integrity of its financial records. It's the financial equivalent of a pre-flight checklist for a pilot. These controls are designed to prevent errors, detect fraud, and ensure the company is complying with laws and regulations. Examples of internal controls are all around us. When a company requires 2 signatures to approve a large payment, that's an internal control. When it separates duties, so the person who approves an expense is not the same person who issues the payment, that's a control. Regular audits, secure passwords for financial software, and systematic reviews of financial statements are all part of a strong system of internal controls. For public companies in the United States, these controls are not just a good idea. They are mandated by law, most notably by the Sarbanes-Oxley Act of 2002. The finance officer is ultimately responsible for making sure this entire system is designed effectively and is operating as it should. In summary, while FP&A is about looking forward, financial reporting and internal controls are about creating a reliable record of the past and a trustworthy picture of the present. The finance officer ensures the story is told correctly and that systems are in place to keep it that way. In our next chapter, we will dive into how a finance officer manages the lifeblood of the organization: its cash. We'll explore the world of treasury management and learn how they handle everything from daily cash operations to corporate investments. Hello and welcome back to our series on what a U.S. finance officer actually does. In our previous chapters, we established how the finance officer acts as a strategic planner for the future and as a guardian of accuracy for the past and present. Today, we delve into one of their most immediate and critical functions: managing the lifeblood of the organization, its cash. Before we proceed, please remember that this information is for educational purposes only. It is a general overview of a corporate function and should not be interpreted as financial, investment, or legal advice. Always consult with a licensed professional for guidance on your personal financial matters. The area of finance we are discussing today is often called treasury management. At its core, treasury management is all about making sure the organization has the right amount of cash, in the right place, at the right time, and in the right currency. A business can be highly profitable on paper, but if it runs out of cash to pay its employees or its suppliers, it can fail very quickly. The finance officer's role here is to ensure that never happens. Let's break down the key activities within treasury management. The first is cash flow management. This is the day-to-day operational side of the job. The finance officer's team is constantly monitoring the cash coming into the company and the cash going out. They work to optimize this flow. For example, they will implement strategies to collect money from customers, known as accounts receivable, as efficiently as possible. This might involve offering small discounts for early payment or setting up automated billing systems. On the other side of the equation, they manage payments to the company's own suppliers, known as accounts payable. While it's crucial to pay bills on time to maintain good relationships, paying them too early can tie up cash unnecessarily. The finance officer's team strategically manages these payments to hold on to cash for as long as is appropriate, maximizing its usefulness to the business without damaging its reputation. The goal is to perfect the timing of inflows and outflows. This leads us to a broader concept called working capital management. Working capital is essentially the difference between a company's short-term assets, like cash and inventory, and its short-term liabilities, like payments owed to suppliers. A finance officer constantly analyzes this to ensure the company is using its resources efficiently. Having too much cash tied up in unsold inventory, for instance, is an inefficient use of capital. The finance officer works with other departments like sales and operations to find the right balance. Enough inventory to meet demand, but not so much that it drains the company's cash reserves. Another critical function is managing banking relationships. The finance officer is the primary point of contact between the company and its banks. This relationship goes far beyond simply having a checking account. It involves negotiating the terms for lines of credit, which are short-term loans a company can draw on if it needs cash quickly. It also involves selecting and managing various banking services, such as payment processing systems or international currency exchange services, to ensure they are secure, efficient, and cost-effective. A strong relationship with bankers is a vital asset for any organization. Finally, what happens when the company has more cash than it needs for its immediate operations? A skilled finance officer doesn't just let that excess cash sit idle in a bank account earning little to no interest. Instead, they are responsible for short-term investing. The primary goal here is not to take big risks for high returns, but rather to preserve the capital while earning a modest return. This cash is typically invested in very safe and highly liquid instruments, such as U.S. Treasury bills, commercial paper, or money market funds. This allows the company to earn a small profit on its idle cash, while ensuring the money can be accessed quickly if needed. In essence, through treasury and cash management, the finance officer ensures the company's financial engine is always well-oiled and running smoothly. They protect the organization from liquidity risks and help it operate with maximum efficiency. Join us in our next chapter, where we will explore how a finance officer identifies and mitigates threats to the organization by stepping into the role of a risk manager. Hello and welcome back. So far in our series, we've seen the finance officer as a forward-looking strategist, a meticulous record keeper, and an efficient manager of cash. Today we explore a different, but equally vital, hat they wear. That of the financial sentinel. Their job in this capacity is to stand guard, identify potential threats to the company's financial health, and build a strong defense against them. This is the world of financial risk management. As always, a reminder that this material is for educational and informational purposes only. We are discussing the corporate function of risk management, and this content is not intended as financial, investment, or legal advice for any individual. For personal guidance, please consult with a licensed professional. So what exactly is financial risk? In a business context, it is any potential event or condition that could negatively impact the organization's financial stability or profitability. These risks are everywhere. They can come from changes in the broader economy, from the actions of competitors, or even from within the company itself. A finance officer cannot eliminate all risks, but they are responsible for creating a system to identify, assess, and mitigate them. Let's break down 3 common types of financial risk that a finance officer manages. First, there is market risk. This is the risk of losses arising from factors that affect the entire market. Think of it like the tide that can raise or lower all boats. This includes things like changes in interest rates. If a company has a large loan with a variable interest rate, a sudden increase in rates could dramatically raise its payment costs. Another example is currency risk. If a US company sells its products in Europe, and the value of the euro falls against the dollar, the revenue from those sales will be worth less when converted back to US dollars. The finance officer uses various financial tools and strategies to hedge, or protect, the company against these broad market movements. Second, we have credit risk. This is the risk that a counterparty, someone who owes the company money, will not be able to pay it back. The most common example is customer credit risk. When a company sells a product to a customer on credit, it's essentially giving them a short-term loan. There is always a risk that the customer will default on that payment. The finance officer is responsible for setting the company's credit policy. They determine which customers are eligible for credit, set credit limits, and establish a process for collecting overdue payments. This is about striking a balance between making sales easier for customers and protecting the company from potential losses. The third major category is operational risk. This is the risk of loss resulting from failed internal processes, people, and systems. Unlike market or credit risk, this threat is internal. It could be anything from a human error in data entry that leads to a significant financial misstatement, to a cybersecurity breach that compromises financial data, or even fraud committed by an employee. The internal controls we discussed in Chapter 2 are the primary defense against operational risk. The finance officer plays a lead role in designing and enforcing these controls to ensure that the company's day-to-day operations are secure and reliable. The process for managing these risks involves 3 steps. First is identification. The finance officer and their team work to identify all the potential financial risks the business faces. Second is assessment. They then analyze each risk to determine its potential impact and the likelihood of it occurring. And third is mitigation. Based on the assessment, they develop strategies to manage the risk. This could involve avoiding the risk, reducing its likelihood, transferring the risk, for example, by buying insurance, or simply accepting the risk if it's small enough. In their role as a risk manager, the finance officer provides the organization's leadership with a clear view of the financial dangers on the horizon, allowing them to navigate with confidence. In our next chapter, we will shift our focus to long-term growth by exploring how a finance officer evaluates and decides on major investments, a process known as capital budgeting. Hello, and welcome back to our in-depth look at the roles of a U.S. finance officer. We've discussed how they plan for the future, report on the past, manage daily cash, and protect the company from risk. Today, we focus on how they help make the massive long-term decisions that define what a company will become years from now. This is the process of capital budgeting and strategic investment. As we dive into this topic, it is crucial to remember that this discussion is for educational purposes only. We are exploring the decision-making process inside a corporation. This is not and should not be considered investment advice for any individual. Please consult a qualified professional for personal financial guidance. So, what is capital budgeting? In simple terms, it's the process an organization uses to evaluate and decide on major, long-term investments or projects. We aren't talking about buying new office supplies. We are talking about high-stakes decisions like building a new manufacturing plant, acquiring another company, or investing millions of dollars to develop and launch a new technology. These decisions are critical because they often involve huge sums of money, the company's capital, and can lock the company into a specific strategic direction for a decade or more. The finance officer is at the very center of this entire process. While the idea for a new project might come from an engineering team or a marketing department, the finance officer is responsible for bringing financial discipline and rigorous analysis to the decision. Their job is to answer the fundamental question: will this investment create value for the organization in the long run? The evaluation process they lead can be broken down into a few key stages. First, the initial idea is developed into a formal proposal. The finance officer's team works with the project sponsors to forecast its potential costs and revenues over its entire lifespan. How much will it cost to build? How much will it cost to operate each year? And most importantly, how much revenue and profit is it expected to generate? Once these projections are made, the real financial analysis begins. The finance officer uses several well-established methods to evaluate the project's financial viability. We won't go into the complex math here, but it's important to understand the questions these methods help answer. For example, one simple method is the payback period. This analysis calculates how long it will take for the project to generate enough cash flow to recover the initial investment. A shorter payback period is often preferred. A more sophisticated technique is net present value, or NPV. This concept is based on the idea that a dollar today is worth more than a dollar tomorrow, because today's dollar can be invested and earn a return. NPV analysis calculates the value of all the project's future cash flows in today's dollars, and then subtracts the initial cost. If the result is a positive number, the project is expected to create value. The finance officer doesn't just look at one project in isolation. They often compare multiple potential projects against each other to see which one offers the best potential return for the company's capital. Furthermore, the analysis doesn't stop at the potential rewards. The finance officer must also rigorously assess the risks, tying back to our last chapter. What if the construction costs run over budget? What if a competitor launches a similar product first? What if the economy changes and customer demand is lower than forecasted? All of these risks are modeled and considered, giving decision-makers a complete picture of not just the best-case scenario, but the potential downsides as well. Finally, after all this analysis is complete, the finance officer presents their findings and a recommendation to the company's senior leadership and board of directors. They act as the objective financial advisor, ensuring that the final decision is based on sound data and a clear-eyed view of the potential returns and risks, rather than on emotion or optimism alone. In this role, the finance officer is the steward of the company's long-term capital, ensuring it is allocated to the projects that will build a stronger and more valuable future. Join us next time as we explore the other side of this coin. Where does a company get the money for these major projects? We'll discuss the role of the finance officer in raising capital. Hello and welcome back. In our last chapter, we explored the critical process of capital budgeting, where a finance officer helps a company decide which major, long-term projects to invest in. That naturally leads to the next big question. Where does the money for these expensive projects actually come from? Today, we're diving into how a finance officer helps fuel the company's engine by managing its capital structure and raising funds. Before we begin, a crucial reminder. This chapter discusses how corporations raise money through debt and equity markets. This information is for educational purposes only, and is not a recommendation or advice on how an individual should invest in stocks, bonds, or any other financial instruments. Please consult with a licensed financial professional for personal investment advice. The first concept to understand is capital structure. This simply refers to the specific mix of debt and equity a company uses to finance its overall operations and growth. To make this easier to understand, think about how someone might buy a house. They typically use a down payment, which is their own money, their equity, and a mortgage from a bank, which is a loan, their debt. A company's capital structure is similar. It's the combination of its own money and borrowed money that it uses to run the business. The finance officer's job is to find the right balance, the optimal capital structure, that allows the company to grow while managing its financial risk. So, how does a company raise this capital? There are two main paths, and the finance officer is central to both. The first path is debt financing. This means borrowing money that must be repaid at a later date, usually with interest. One common way to do this is by getting a term loan from a bank, much like an individual gets a mortgage. The finance officer is responsible for negotiating the terms of these loans, including the interest rate, the repayment schedule, and any other conditions. Another major form of debt financing is issuing bonds. A corporate bond is essentially an IOU from the company to an investor. The company sells these bonds to investors and, in return, promises to pay periodic interest payments over a set term, and then return the original amount, known as the principal, at the end of that term. From the company's perspective, debt is often a cheaper way to raise money than selling ownership. However, it also comes with a significant risk. The company is legally obligated to make its interest and principal payments, no matter how well the business is doing. The second path is equity financing. Instead of borrowing money, a company can raise capital by selling ownership stakes to investors. The most common way to do this is by issuing stock. Each share of stock represents a small piece of ownership in the company. When an investor buys a share of stock, they are buying a claim on the company's future profits. The most famous example of this is an initial public offering, or IPO, which is when a private company first sells its stock to the public and becomes a publicly traded company. From the finance officer's perspective, the great advantage of equity financing is that the company gets cash with no obligation to pay it back. There are no mandatory interest payments. The downside, however, is that issuing new stock dilutes the ownership of the existing owners. Each new share that is sold means the existing owners now own a slightly smaller percentage of the company. The finance officer's strategic role is to analyze the trade-offs between these two options. They must consider the company's current financial health, its growth prospects, and the conditions in the overall financial markets to recommend the best way to raise the funds needed for the company's future. In our next chapter, we will discuss what happens after the money has been raised. We will explore the ongoing and vital role of investor relations. Hello and welcome back. In our last chapter, we discussed the high-stakes process of raising capital by bringing on debt or equity partners. But once a company has investors, the relationship has only just begun. Today we explore the finance officer's crucial role as the voice of the company, managing the vital, ongoing communication with the financial world. This is the function of investor relations. As we proceed, please remember this important point. The information provided is for educational purposes only. We are describing a corporate communications function. This is not advice on how to interpret company communications for personal investment purposes. For that, you should always consult a licensed financial professional. So, what is investor relations, often shortened to IR? Investor relations is the strategic function responsible for managing communication between a company and its investors, as well as the broader financial community, which includes financial analysts and the media. The primary goal of an IR program, which the finance officer typically oversees, is to provide a complete, accurate, and timely account of the company's performance and strategy. The ultimate aim is to build credibility and trust with the market. In the United States, this communication is not just a good idea, it's governed by strict regulations. For example, Regulation Fair Disclosure, or Reg FD, is a key rule from the Securities and Exchange Commission that mandates that when a public company discloses important information, it must do so to all investors at the same time. This prevents selective disclosure to favored investors and ensures a level playing field. The finance officer is a key figure in ensuring the company abides by these rules. So, how does this communication actually happen? A major part of it revolves around the quarterly earnings cycle. For a public company, every 3 months is like a major exam. The company must report its financial results for the preceding quarter. This process, led by the finance officer and their team, usually involves 2 key events. First is the earnings press release. This is a written document that provides the headline numbers, such as revenue, expenses, and profit, and gives management's summary of the quarter's performance. Immediately following the press release is the earnings conference call. This is a public call where the CEO and the finance officer present the results in more detail and provide their outlook for the future. After their prepared remarks, the call is opened up for questions from financial analysts. These analysts are professionals whose job is to study companies and provide research and ratings to investors. The finance officer must be prepared to answer deep, challenging questions about every aspect of the company's financials. Beyond the quarterly cycle, the finance officer is responsible for overseeing the creation of official SEC filings. The most well-known of these is the annual report, or the Form 10-K. This is an extremely detailed document that provides a comprehensive overview of the company's business, its financial statements, and a discussion of the risks it faces. This document is the official source of truth, providing the detailed data that backs up the stories told on conference calls. Finally, the role involves direct engagement. Finance officers, along with their CEOs, spend a significant amount of time at investor conferences and on roadshows. These are meetings where they present the company's strategy and performance to large institutional investors, like mutual funds and pension funds. It's their job to articulate a clear and consistent narrative about where the company is headed and why it is a sound organization. In all of these activities, the finance officer acts as the bridge between the company's internal reality and its external perception, ensuring the financial story is told with accuracy, clarity, and integrity. Next time, we will turn our focus back inside the company to explore how the finance officer partners with other departments to drive better business decisions. Hello and welcome back to our series. We've spent a lot of time discussing the finance officer's role in high-level strategy and in communicating with the outside world of investors. But some of their most important work happens inside the company, working shoulder to shoulder with other departments. Today, we explore the modern role of the finance officer as an internal consultant and a strategic business partner. As always, we must begin with our reminder. This content is for educational purposes only. It describes the internal collaborative functions within a business, and is not intended to be financial or business advice for you or your organization. For specific guidance, please consult with qualified professionals. In the past, the finance department was sometimes seen as the no department.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The gatekeepers who only focused on cutting costs and enforcing budgets. While fiscal discipline is still crucial, the modern finance officer's role has evolved to be far more collaborative. They and their teams are now expected to be proactive partners who use their financial expertise to help other departments achieve their goals more effectively. This is what's known as business partnering. Let's look at a few examples of how this works in practice. Consider the marketing department. A marketing team might have a brilliant idea for a major new advertising campaign. In a business partnering model, they don't just ask the finance officer for money. Instead, they work with the finance team from the very beginning. The finance team helps them build a business case for the campaign. They provide data and analysis to help answer key questions. What is the expected return on investment, or ROI, for this campaign? How will we measure its success? Are there more cost-effective ways to reach the same audience? By providing this data-driven perspective, the finance officer helps ensure that marketing dollars are spent in the most impactful way possible. Next, think about the operations or manufacturing department. Let's say the head of operations wants to invest in a new piece of machinery to make production more efficient. The finance officer's team would partner with them to perform a detailed cost-benefit analysis. They would look at the upfront cost of the machine, but also factor in the long-term savings from reduced labor costs, faster production times, or fewer defects. They might also analyze different financing options, like leasing the equipment versus buying it outright. This partnership ensures the decision isn't just about having the newest technology, but about making a sound financial investment that benefits the entire company. This partnership extends to every corner of the business, including human resources. When HR is developing salary bands for new roles or considering changes to employee benefits packages, the finance team provides the essential analysis. They model the long-term financial impact of these decisions, ensuring the company can attract and retain top talent while remaining financially sustainable. They help answer questions like, what is the total cost of a new hire beyond just their salary? What is the financial impact of different healthcare plans? In each of these examples, the finance officer is not dictating decisions. Instead, they are providing the tools, data, and financial insights that empower other department heads to make smarter, more informed choices. They are translating the numbers into a language that everyone in the business can understand and use to improve performance. This shift from being a scorekeeper to a strategic partner is one of the most important evolutions in the role of the modern finance officer. Next time, we will tackle one of the most complex and high-stakes responsibilities a finance officer can face: navigating mergers and acquisitions. Hello and welcome back. We've explored how a finance officer helps a company run smoothly and grow organically. But sometimes, a company makes a bold move to grow much faster or acquire new capabilities by buying, selling, or merging with another company. Today, we step into one of the most high-stakes arenas a finance officer can enter: the world of mergers and acquisitions, or M&A. Before we explore this topic, it is essential to state that this discussion is for informational purposes only. We are describing the complex corporate process of M&A from a professional's perspective. It is not, and should not be taken as, advice on how to analyze or invest in companies involved in M&A activities. For any investment decisions, please consult a licensed financial professional. Mergers and acquisitions are transactions in which the ownership of companies, or their operating units, are transferred or combined. This can be a merger of two equals, or an acquisition, where a larger company buys a smaller one. The finance officer is a central architect in this entire process, from the initial idea to the final integration. The M&A journey begins with strategy and identification. The finance officer works with the CEO and other leaders to identify potential target companies that align with their strategic goals. Perhaps they want to enter a new market, acquire a specific technology, or eliminate a competitor. The finance team analyzes the financial landscape to find companies that fit this profile and appear to be a good strategic fit. Once a potential target is identified, the most critical phase begins: due diligence. You can think of this as a complete and thorough investigation of the target company before a purchase is made, much like you would get a home inspected before buying it. The finance officer leads the financial due diligence. Their team pores over the target company's financial statements, contracts, debt agreements, and tax records. They are looking for any red flags, hidden liabilities, overstated revenues, or any other financial skeletons in the closet. This is meticulous, investigative work designed to ensure the company knows exactly what it is buying. Simultaneously, the finance officer is responsible for valuation. This is the process of determining a fair price for the target company. How much is it actually worth? There are many complex methods for valuing a business, but the goal is to arrive at a price that is fair to both the buyer and the seller. The finance officer's analysis provides the foundation for the purchase offer and sets the boundaries for negotiation. With a valuation in hand, the finance officer then plays a key role in deal structuring and negotiation. They help decide how the company will pay for the acquisition. Will it be an all-cash deal? Will they use their own stock as currency? Or will it be some combination of the two? Each option has different financial and strategic implications. The finance officer provides the analysis to guide this decision and often sits at the negotiating table, helping to hammer out the financial terms of the final agreement. Finally, after the deal is signed, the work is far from over. The last stage is integration. This is the complex process of combining the two companies into a single, cohesive entity. From a financial perspective, this means merging accounting systems, payrolls, and financial reporting processes. The finance officer's team must ensure this integration is seamless and efficient, capturing the value that was expected when the deal was first conceived. In every stage of an M&A deal, the finance officer acts as the analytical backbone, providing the data-driven insights needed to make one of the most significant decisions a company can ever undertake. Next time, we will explore how technology is fundamentally changing the role of the finance officer and the entire finance function. Hello and welcome back. We have journeyed through the many strategic roles of a finance officer, from planning and reporting to managing massive M&A deals. But underlying all of this work is a powerful and ever-changing force: technology. Today we're exploring how technology, data, and automation are completely reshaping the modern finance function and redefining the role of the finance officer. As always, we remind you that this content is for educational purposes only. We are discussing broad technological trends within the finance profession, not recommending specific software or technology strategies. For advice related to your specific situation, please consult a qualified professional. For decades, the work of finance and accounting was characterized by manual, time-consuming tasks, entering data, reconciling accounts, and building reports from scratch. Technology has fundamentally changed this reality. The first major shift has been automation. Modern financial software, particularly large systems known as enterprise resource planning or ERP systems, now automates many of these routine tasks. Invoices can be processed automatically, bank statements can be reconciled by algorithms, and standard financial reports can be generated with a single click. This automation doesn't replace finance professionals. Instead, it frees them from repetitive work and allows them to focus on higher value activities. This leads directly to the second major shift: the rise of data analytics. With the grunt work automated, the finance officer and their team can spend more of their time analyzing the vast amounts of data the business generates. They are moving beyond simply reporting what happened, and are now using powerful analytical tools to understand why it happened. Furthermore, they are using this data to build predictive models to forecast what is likely to happen next. This allows them to provide much deeper, more forward-looking insights to the company's leadership. Instead of just presenting last quarter's results, a modern finance officer can now present a data-driven forecast of next quarter's sales based on current market trends, or model the financial impact of 3 different strategic decisions. Fueling this data-driven approach is the third key technology: cloud computing. By using cloud-based financial software, companies can ensure that everyone from the CEO to a sales manager has secure, real-time access to the financial data they need to do their jobs, from anywhere in the world. This breaks down information silos and fosters a more collaborative and agile decision-making culture. The finance officer is no longer the sole keeper of the data. They are the curator of a single source of truth that the entire organization can rely on. Finally, with this increased reliance on digital systems comes a new and critical responsibility: cybersecurity. The finance officer, as the steward of the company's most sensitive financial data, now plays a crucial role in the company's cybersecurity strategy. They work closely with the Information Technology Department to ensure that robust controls are in place to protect financial systems from fraud, data breaches, and other cyber threats. In essence, the modern finance officer is becoming part technologist, part data scientist, and part digital strategist, using powerful new tools to drive their organization forward with greater speed and intelligence. Next time, we will discuss the foundational role of the finance officer in upholding the integrity of the company through ethics and corporate governance. Hello and welcome back. In our journey so far, we've explored the many strategic and operational duties of a finance officer. But underpinning every decision they make and every report they sign is a rigid framework of rules, laws, and ethics. Today, we're focusing on the finance officer's fundamental role as a guardian of integrity, exploring the world of corporate governance, compliance, and ethics. As we discuss these topics, which touch upon legal and regulatory standards, it's vital to remember that this is a general educational overview. This content is not legal or tax advice. For specific guidance, you must always consult with a licensed professional. Let's start with corporate governance. Think of this as the internal constitution of a company. It is the system of rules, practices, and processes by which an organization is directed and controlled. Good governance ensures that the interests of all stakeholders, including shareholders, management, employees, and the community, are balanced. The finance officer is a key architect of this system. They are responsible for providing the company's board of directors with transparent, accurate, and timely financial information. This allows the board, which represents the shareholders, to properly oversee management and make informed strategic decisions. Next, we have compliance. If governance is the internal rulebook, compliance is about adhering to all the external laws and regulations. A finance officer is responsible for ensuring the company stays on the right side of the law in many different areas. A major one is tax compliance. They ensure that the company accurately reports its income and pays the correct amount of taxes to government bodies like the IRS. For publicly traded companies, another critical area is compliance with the Securities and Exchange Commission, or SEC. This includes following a set of rules known as Generally Accepted Accounting Principles, or GAAP. GAAP is the common standard for financial accounting in the U.S., ensuring that financial reports from different companies are consistent and comparable. Landmark laws, such as the Sarbanes-Oxley Act of 2002, place direct responsibility on the CEO and finance officer to personally certify the accuracy of their company's financial statements, making this compliance role more important than ever. Finally, beyond the formal systems of governance and compliance, there is the personal responsibility of ethics. The finance officer must serve as the ethical compass for the organization, particularly on financial matters. Their ultimate duty is to the truth. They are responsible for ensuring that the financial picture they present is honest and free from manipulation, even when the numbers might reveal bad news. This requires immense personal integrity and the courage to challenge decisions that might be profitable in the short term, but are unethical or legally questionable. In summary, the finance officer is much more than a strategist or a numbers expert. They are a pillar of integrity. Through their leadership in corporate governance, their diligence in compliance, and their unwavering commitment to ethics, they ensure the company not only succeeds, but succeeds in the right way. Next time, we will take a deeper dive into one of the most complex areas of compliance: corporate tax strategy and planning. Hello and welcome back. In our last chapter, we focused on the ethical and legal framework that guides a finance officer. Today, we are taking a deeper look into one of the most complex and significant areas of that framework: corporate tax. We will explore the finance officer's role in navigating the intricate labyrinth of tax law. Before we go any further, we must provide a very clear and important disclaimer. Tax laws in the United States are incredibly complex, constantly changing, and depend heavily on specific circumstances. This video is for educational purposes only, to describe the professional function of tax management within a large organization. It is absolutely not tax advice for any individual or any business. Always consult with a qualified and licensed tax professional for any tax-related questions or decisions. In our last discussion, we mentioned tax compliance. This is the non-negotiable, foundational duty of the finance officer to ensure the company calculates its tax obligations accurately, files all necessary returns on time, and pays what it legally owes. But beyond simple compliance, there is a more proactive function: tax planning, or tax strategy. Tax planning is the legal and ethical process of arranging a company's financial affairs to minimize its total tax liability. To use an analogy, if compliance is about accurately reporting how many miles you drove, Tax planning is about choosing the most fuel-efficient route to your destination that is legally permissible. The finance officer has a duty to the company's shareholders to manage all expenses, and taxes are a significant expense. The goal is to ensure the company pays its fair and legally required share, but no more than that. The finance officer's role in tax strategy is woven into almost every major business decision. For example, when the company is considering a large investment, as we discussed in the capital budgeting chapter, the finance team analyzes the tax implications. Governments often offer tax incentives, such as credits or deductions, to encourage certain business activities. These might be for investing in research and development, purchasing environmentally friendly equipment, or building a facility in a specific economic development zone. The finance officer's team is responsible for identifying and understanding these incentives, so they can be factored into the decision-making process. Tax strategy also involves jurisdictional planning. Tax laws can vary dramatically not just between countries, but also between different states within the U.S. When a company is deciding where to build a new factory, set up a distribution center, or establish a sales office, the finance officer provides analysis on how those different locations will impact the company's overall tax obligations. This is a critical piece of information that helps leadership make the most informed decision. It is crucial to understand that the finance officer is rarely a lone expert in this field. They are the strategic leader who oversees the function, but they work very closely with a team of highly specialized professionals. This includes internal tax accountants, external tax advisory firms, and specialized tax attorneys. The role of the finance officer is to integrate the expert advice from these professionals into the company's broader financial and corporate strategy. In summary, the finance officer is the steward of the company's tax position. They are responsible for the absolute integrity of tax compliance, while also leading the strategic, legal, and ethical planning that helps manage one of the company's most significant financial obligations. Next time, we will shift our focus to the human side of the finance function, exploring the finance officer's role as a leader. Hello and welcome back to our series. We have explored the strategies, the technologies, and the ethical responsibilities of a U.S. finance officer. But none of this work happens in a vacuum. It is accomplished by a dedicated team of professionals. Today we focus on the human element, exploring the finance officer's critical role as a leader who builds and guides the modern finance team. As always, we remind you that this content is for educational purposes. We are describing general principles of management and team structure within a corporate environment. This is not career or management advice for any specific individual or situation. The role of the finance department has changed dramatically, and so has the composition of the team. In the past, a finance department was primarily staffed with accountants focused on bookkeeping and compliance. While those skills remain essential, they are no longer enough. The modern finance officer must build a team with a much broader and more dynamic set of skills. Today's finance teams need data analysts who can turn raw information into strategic insights. They need business partners who can collaborate effectively with marketing and operations. And they need tech-savvy professionals who can manage and leverage sophisticated financial software. The finance officer is responsible for identifying these needs and recruiting, training, and retaining the talent to meet them. Within a typical finance department, the finance officer leads several key functions. There is usually a controller, who is responsible for the accounting side of the house, ensuring the books are accurate, reports are filed correctly, and internal controls are strong. Then there is the financial planning and analysis, or FP&A team, which we've discussed before. These are the analysts who manage the budgeting and forecasting processes and act as strategic partners to the business. In larger organizations, there may also be specialists, such as a treasurer who manages cash and banking relationships, or a head of tax. The finance officer's leadership role is to make sure all these different functions work together as a cohesive unit. But more than that, they must create an environment where talented finance professionals want to work and build a career. This means providing clear paths for professional growth, and investing in training to help the team keep up with the latest technologies and regulations. It means fostering a culture of curiosity and continuous improvement, where team members are encouraged to challenge old assumptions and find better ways of doing things. Ultimately, the finance officer's most important leadership task is to set the vision for the team. It is their job to elevate the department's role from a back-office support function to a vital strategic partner in the organization's success. They lead the charge in transforming the finance team into a group that doesn't just report on the value the company has created, but actively helps to create more of it. Next time, in our second-to-last chapter, we will look at a crucial external relationship: the finance officer's role in working with independent auditor. Hello and welcome back. In our last chapter, we discussed the finance officer's role as a leader of their internal team. Today, we turn our attention to one of the most important external relationships they manage: the one with independent, external auditors. This partnership is a cornerstone of the financial system, designed to create trust and transparency for investors and the public. As always, a reminder that this is an educational overview of a professional process. This content is not accounting or legal advice and should not be used for making any financial decisions. For specific guidance, please consult with a licensed professional. First, what is an external audit? Think of it as a formal, independent inspection of a company's financial health. For public companies in the United States, an annual audit is a legal requirement. The audit is conducted by a certified public accounting, or CPA firm, that is completely independent of the company. Their job is to examine the company's financial statements and internal controls, and then issue a formal, public opinion. This opinion states whether the financial statements are accurate, free from material misstatement, and prepared in accordance with generally accepted accounting principles, or GAAP. The key word here is independence. The auditors do not work for the company's CEO or even the finance officer. They are hired by and report directly to the audit committee of the board of directors. Their ultimate duty is to the company's shareholders and the public, providing an unbiased and objective assessment. The finance officer is the primary liaison for this entire process. Their role is not to control the audit, but to facilitate it and ensure it runs smoothly and efficiently. This involves several key stages. Long before the auditors arrive, the finance officer leads the preparation stage. This means ensuring that all financial records, supporting documents, and internal control documentation are in order and ready for inspection. A well-prepared company makes for a much smoother audit process. During the audit, the finance officer is the main point of contact, responsible for facilitation. They coordinate with their team to handle the auditor's many requests for information, from providing detailed transaction histories to explaining complex accounting treatments. They answer tough questions and ensure the auditors get the access they need to do their job thoroughly. If the auditors identify potential issues or areas of concern, the finance officer is responsible for resolution. This involves working constructively with the audit team to understand their findings, provide additional information or context, and if necessary, make corrections to the financial statements. This is a professional dialogue aimed at reaching the most accurate possible conclusion. Finally, after the audit is complete, the external auditors will issue their official report and opinion. The finance officer, along with the auditors, will present these results to the audit committee. This closes the loop on a process that is fundamental to maintaining trust in the capital markets. While the audit process can be intense and challenging, it is a vital partnership. Through this rigorous, independent review, the finance officer helps provide the ultimate assurance to investors that the company's financial story is one that can be trusted. Next time, in our final chapter, we will look to the horizon and discuss the future of the finance officer role, summarizing everything we have learned. Hello, and welcome back for the final chapter in our series on what a U.S. finance officer actually does. We have journeyed through 15 distinct aspects of this critical role, from high-level strategy to the intricate details of compliance. Today, we will bring everything together, summarizing the multifaceted role of the modern finance officer, and looking ahead at the trends and challenges that are shaping its future. Before we conclude, a final and important reminder. This entire series has been produced for educational and informational purposes only. We have described the functions of a corporate professional. Nothing in this series should be interpreted as financial, investment, legal, tax, or career advice. For any personal or business decisions, please consult with a licensed and qualified professional. Over our series, we have painted a picture of the finance officer that is far more complex than the traditional view of a simple accountant. We have seen them as a strategist, leading the charge on financial planning, making critical capital budgeting decisions, and navigating the high-stakes world of mergers and acquisitions. We've seen them as a steward, responsibly managing the company's cash, overseeing accurate financial reporting, and ensuring compliance with complex tax laws. We have also seen the finance officer as a leader and a partner, building a modern finance team and working collaboratively with every department to drive better business outcomes. They are the spokesperson to the outside world, clearly and honestly communicating the company's financial story to investors. And perhaps most importantly, they are the guardian of integrity, upholding the highest ethical standards and working with auditors to ensure the absolute trust and transparency of the company's financial position. So, what does the future hold for this already complex role? Several key trends are shaping the next generation of financial leadership. First is the growing importance of ESG, which stands for environmental, social, and governance. Investors and the public are increasingly demanding that companies report not just on their financial performance, but also on their impact on the planet and society. The finance officer is now being tasked with measuring, reporting, and helping to improve these non-financial metrics, a major expansion of their traditional responsibilities. Second, technology will continue its relentless march. The rise of artificial intelligence and advanced data analytics is moving the finance function beyond just predicting what might happen. The new frontier is prescriptive analytics, where technology can recommend the optimal course of action. The finance officer of the future will need to be even more of a data scientist, capable of leveraging these powerful tools to find new opportunities and mitigate risks. Finally, the role will become even more crucial in a world of increasing geopolitical and economic volatility. A skilled finance officer who can help a company navigate supply chain disruptions, inflation, and shifting global markets is more valuable than ever. In conclusion, the role of the finance officer has evolved from a historical record keeper into a forward-looking, technology-driven, and strategic leader. They are the analytical engine, the ethical compass, and the strategic partner at the heart of the modern American enterprise. Thank you for joining us on this comprehensive journey.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.